Hi folks, welcome to this video on fair value through OCI investments. What we're going to do here are two things. First of all, we're going to make all the journal entries associated with the investment, and then I'm going to produce a second video which is going to show you how we would present information related to fair value through OCI investments in the Statement of Comprehensive Income as well as the Statement of Financial Position. Okay, so now, if we look at the data that we have at the end of December of this year, it's a good thing. They give it to you, even though they ask you to make journal entries during 2017 and 18. It's a good idea to know where you're starting, because I'm thinking that in the second video you're going to have to do financial statement presentation. So it's always good to be able to compare the cost at the end of the period, okay, against the fair value, so you can figure out which your AOCI balance is going to be going into 2017, because don't forget it's a balance sheet account and you need to know from where you're starting. So in this particular case, the fair value through OCI investment portfolio has shares of three different companies in it: Earl, Josie, and Asher. And they've told you that at the end of 2016 how many shares of each different company there is in the portfolio, the cost, the original cost of each of the shares that they have, and the fair value of those shares at the end of 2016. So when we compare the original cost, which was the cost at the date those shares were purchased, to the fair value at the end of 2016, we see that in our AOCI account, we have a debit balance of $7,550. And don't forget, all we're doing here when we're calculating our AOCI balance, it's in the shareholders' equity section, and what is it telling us? It's giving us the cumulative value of all the unrealized gains and losses that have been booked in the fair value through OCI investment portfolio since the beginning of time. So the beginning of time was cost. The fair value at the date we're calculating our AOCI for is $29,950. So since the fair value is less than the original cost, that's exactly what we have in our AOCI account, the difference between the two. And because fair value is less than cost, we have a debit balance of $7,550. So now we're going to move on from there and prepare the journal entries for 2017 and 18. And the first thing we see is that on March the 1st, Josie paid a $2 per share dividend. Well, how many shares of Josie do we have? 900 times $2 a share. You'll remember with the fair value through OCI investments, we don't credit an investment income loss account, but we use a dividend revenue or dividend income account. So we debit cash and credit our dividend revenue as the company Castlegar for $1,800. And April the 30th begins our journey, because now we've sold one of these fair value through OCI investments, or part of it, okay, because we decided not to keep it. So what did we sell? We sold part of our shares of Asher. So here's an example where we had 500 shares of Asher. We're not selling the whole 500 shares. We're only selling part of the shares. So what do we need to do? Don't forget there's a three-step process. First thing we need to do is update the shares that we're selling, right? And in this case, we're only selling 300 shares. We have to update those shares to their fair value. Step 1. Step 2, dump them, sell them. Prepare the entry to sell the shares. And number 3, step 3, very important. Now we have to look at all of the cumulative unrealized gains or losses that have built up on these 300 shares of Asher. And then what we have to do is we have to reclassify them into retained earnings, because in this question it's without recycling. So we're not recycling them into net income. All we're doing here with fair value through OCI investments, equity investments in particular, we're reclassifying them into retained earnings because it's without recycling. So let's go through all of those 3 steps. Well, first of all, we know that the fair value of those shares at the end of 2016 was $7.20. So we would have made a journal entry at that time to adjust the value of the shares to $7.20. Well, guess what? We sold them for $10. Why? Because that must be what they're trading for in the marketplace. So we got $10 a pop. So what do we need to do? We need to adjust the value of those 300 shares by $2.80 a share. So we're going to debit the fair value through OCI investments for $840, which is basically $2.80 right here. The old fair value compared with the new fair value. Or don't forget that $7.20 is your carrying value, right? Compare it to the value of the shares at the date you sold them. $10 multiplied by the number of shares you're selling. So you're going to increase your fair value through OCI investments to their fair value. Debit that account $840 and credit the unrealized gain or loss through OCI. Don't forget that's your OCI account for $840. That's step one. Step two would say dump the shares. Well, we're only dumping or selling the shares that not all 500, but just the 300 that we're holding of the 500. And we're selling them at $10 a share, right? So we're going to debit cash and credit our fair value through OCI investments for $3,000. Again, you're only doing these three steps, only for the shares that you're selling. In this case, you had 500 shares of Asher, but you're keeping 200 because you're only selling 300. Step three would say now we have to look at all of our cumulative unrealized gains and losses on these 300 Asher shares and reclassify them to retained earnings. So what do you have? Well, cumulatively, you know that you bought them at $9 a share, but now you've sold them at $10 a share, right? So cumulatively, you've got an unrealized gain of $1 a share. So what are you going to do? That gain is going to be reclassified. So we're going to debit the gain, the unrealized gain or loss. Why? Because you've got on the 300 shares to date, you've got a $300 cumulative unrealized gain on them. But we're going to reclassify that gain. So we got to debit the gain and credit retained earnings. And that'll be for $300. And how we get it is we take the difference between the cost, the original cost, which was the fair value of the investment at the time we bought it, to the time we revalued it to $10. Don't forget, this was your revaluation, right? When you increase the investment and increase the unrealized gain. So, in that case, we know that we adjusted it to $10. It was sitting at $9 when we first bought it. So cumulatively, we're going to release that $300 gain, all right, to retained earnings. We're going to reclassify it in there. All right, so there's your three-step process. We're going to look at the statements later. We're not going to look at them now. We're just going to do the entries first. Now what happened? Well, on May the 15th, it says that we purchased 200 more Earl Corporation shares at $16 a share. Well, we had 1,000 of them to start the period, right? We had 1,000. Now we're buying 200 more at $16 a share. So we've increased our portfolio by $3,200 and we're paying cash. Now what happened? On December the 31st, that's our year end, at the end of December 2017, now we have to adjust our portfolio from its current carrying value to its fair value. So we're seeing here the portfolio's gone up by $8,110, but let's see where we get the number. First of all, we have to compare our carrying amount to our fair value. Notice that I've got cost here, but I'm not going to use this at this point. I don't need to use the cost yet. I'll use it later, but I'm keeping it in here. All I'm doing is I'm calculating or comparing the carrying amount that I've got them at my books on right now at December 31st, 2017 to what I need to get it at. It's the difference between these two amounts that's going to help me calculate the unrealized or holding gain or loss for the period that's going into OCI. So let's see how we calculated it. Well, don't forget, I just bought 200 of these 1,200 Earl shares this year. And I bought them at a different price, at $16. But I was already carrying 1,000 of them at $11.50. Where's the $11.50 from? Don't forget, it's the fair value that I adjusted it to at the end of the previous year, 2016. Right? So I've got 1,000 shares sitting in my fair value through OCI investment account before the fair value adjustment. I've got 1,000 sitting at $11.50. And I've got 200 sitting at what I paid for them this year in 2017. So I've got $14,700 in carrying value. The Josie shares, I've got $900 shares, and the most recent fair value that I've assessed for it, which is the carrying amount, is $16.50. Go back to the end of 2016. You adjusted them to $16.50 a share. So now if I compare that, or if I do the math, I've got $14,850. The Asher shares, don't forget, by the time I get to December 31st, right, I don't have 500 shares to value. I've only got 200 shares to value. And I've got them sitting on my books now at what value? The most recent fair value, because these shares I didn't sell. I'm still holding on to them, right? 200 of them are sitting on my books at $7.20 a share. So what's going to happen? I've got them sitting at $7.20 a share, so that's $14.40, and that's in there. So I've now got a carrying value of $30,990. But what's the fair value? Well, the question gives you the fair values. It tells you the fair value for the Earl shares are $17 a share. The fair value for the Josie shares are $19 a share. And the fair value for the remaining Asher shares, the ones you haven't sold, are $8 a share. So here are your fair values. Plug them in here. The total is $39,100. So your portfolio of all the shares you currently hold has gone from $30,990 to $39,100. That's an increase of $81.10. So I'm going to debit my fair value through OCI investments and credit my unrealized gain or loss, which is an OCI account, for $81.10. And now I've got the entries straightened around for that. So now, what happened in 2018? Let's look at the entries there. Well, what do we see? The first thing in 2018 is now the remaining 200 Asher shares are sold for $7 a share. What do? First thing we do is we adjust those shares to their fair value. Well, don't forget, we just adjusted our portfolio at the end of 2017 to show those shares in our portfolio at $8 a share, right? So to do that, or to make our journal entry, we're going to debit the unrealized gain and credit the fair value through OCI investment. So don't forget now, what have we got them at? If it said we sold them for $7, we've got them valued at $8, right? So what's going to happen? We've got the $7 that we have to adjust them to, which is $1 lower than they're sitting in our books at. Don't forget, we had to make part of this $8,110 adjustment sets those 200 shares at $8 a share, right? Which is $1,600. We sold them for $1 less. So we now have to book to get them to their new market value, which is $7 at the date we sold them, from where we just adjusted them to at the end of 2017, which was $8 a share. We're bringing them from 8 to 7. So we're adjusting our portfolio downward, right? By how much? For the 200 shares we're going to be selling, we have to adjust the portfolio down by $1 a share. So we're going to debit the unrealized gain or loss account because it's an unrealized loss at this point, and credit our fair value through OCI investments for $200. Now that we've got those shares sitting at $7 a share, we have to dump them. So how much money do we get for them? In our step 2 adjustment, we debit cash for $1,400 and then credit our fair value through OCI investments for $1,400. So that removes the shares from our books. Remember what happens in step 3. If we no longer have the shares of Asher Corporation, then we also need to release that cumulative unrealized gain or loss. We can no longer keep that in our books. We're going to have to reclassify it into retained earnings. So what do? Cumulatively, don't forget, we bought those shares. If you check your textbook, and we'll go back up here and show you, we originally bought those Asher shares for $9. We now sold them, the remaining Asher shares, for $2 a share. So on those remaining shares, right, we sold them for $7 a share. So cumulatively, we booked cumulatively from the time we bought them now to the time we're selling them on those 200 shares, we've cumulatively got an unrealized gain or loss debit, or an unrealized loss in our OCI account on those 200 shares of of $400 $400 or $2 a share. So what's going to happen? I have to close out that loss. A loss is a debit balance. So to reclassify it, I'm going to have to credit that unrealized gain or loss account to close out that unrealized, specifically the unrealized loss. I'll just make that red so you know we're dealing with a loss, right? And then I'm going to debit or reduce my retained earnings by 400. And that reclassifies it from a cumulative unrealized loss sitting in OCI, which is a debit balance. If I credit it, it zeroes it out and it moves it into retained earnings. So I'm debiting or reducing retained earnings for that amount of the loss. On March the 1st, what happens? Now, Josie, I still have 900 shares, and Josie Corporation has paid me a $2 dividend again. So I'm going to debit cash and credit my dividend revenue for $1,800. Remember, unlike the fair value through net income investments, any dividend on these types of fair value through OCI equity shares, they go to dividend revenue. So now, what happened next? It said here, at December 21st, Earl Corporation declared a $3 per share dividend to be paid in the next month. All right. Now, they don't give us a date when we made the journal entry, but we know they declared at that date. So most students would probably debit dividends receivable and credit dividend revenue. Why? Because it was on December 21st that Earl declared the cash dividend. But when they declared it, we don't necessarily know when the company will accrue it. So I'm assuming that you would do it on December 21st. Some people might do it on the 31st, which is the last day of the period. But you're still waiting to receive a dividend, and you're going to credit your dividend income for how much? You have 1,200 shares of Earl, and they're giving you a $3 dividend. But it's not going to be paid to you until next month. So you set up as a receivable, and you credit your revenue account. Now, on December 31st, what happened? They give you the market prices of Earl and Josie. Don't forget, you have no more Asher shares. So now we have to make a journal entry at the end of 2018 to adjust our portfolio of fair value through OCI equity investments from their carrying value to their fair value. So what do we have? Well, if we go back, we know the carrying amount and of the Earl and the Josie shares. We can go back now to our fair values from the last period. So 20,417.1 should be what we had last period to end 2017. So let's go back and have a look. And here they are here, Earl and Josie. Why can I just take these values? Because there's been no sale or purchase of any additional shares of either Earl or Josie in the period. So that is the most recent carrying value for the shares at December 31st, 2018. This is their fair value at the end of 2017. There's been no activity in the account until I now go in and see what are these shares trading at the end of 2018. I'm going to compare the fair value I've got on my books for these two shares, Earl and Josie, to what they are now, their fair value. And I've got their fair value here. Carrying amount is $37.5, but their fair value is given to me as $19 a share and $21 a share in the question. So now their fair value is $41,700. So my portfolio has gone up $4,200. So I'll debit the fair value through OCI investments to increase them by $4,200 and credit the unrealized gain or loss in OCI by $4,200. So this concludes our journal entries for the portfolio that Castlegar has for its fair value through OCI equity investments. What we're going to do in the next video is we're going to do the next part of the question, and we're going to prepare the comparative statements for 2017 and 18. So I hope you found this video helpful.